Today, actually, we are having a session which is recorded and transmitted to you in terms of the course outline, and actually this has been arranged due to some unavoidable reasons that I would not be able to have the regular session on Saturday morning. But you will see here the details of the discussion that we are continuing, and the areas where you require further clarification, you may keep them noted. We can actually discuss in the following week's lecture. So what I'm basically trying to take you through is the discussion that we have already started in terms of the interest rates, the behavior of interest rates, and you have already come to the point where you have discussed about the determinants of asset demand, where wealth, expected return, risk, liquidity, these factors being detailedly discussed in our discussion. But at the same time, we also looked at the theory of portfolio choice. So we discussed about the theory of portfolio choice, and then of course we looked at the factors that drive the direction in which demand varies in terms of movements of these factors. And then also we gradually move into the demand and supply side of the bond market, and you probably recognize a very interesting two facts, that is at lower prices, that reflects the price and interest rate relationship. Lower prices refers to higher interest rates. I said lower prices refers to higher interest rates, and the relationship is inverse, if not negative. Other things being kept on constant, that is the general principle in economics, the ceteris paribus principle. So at lower prices, invariably higher interest rates, the quantity demanded for bonds is higher. That is one principle that you have learned in terms of supply and demand curves that we are now trying to approach. And at the same time, while the interest rates high, that means the prices are low. At similar position, where the lower prices, the quantity supplied by suppliers is lower. So lower prices, lower supply, a positive relationship. And at lower prices, higher demand. It's a inverse negative relationship. So this being kind of elaborated and discussed in length at our discussion last week, and then we came to describe so-called demand curve and supply curve for bonds, and we have elaborated in detail in terms of the lower prices, where the suppliers feel that they have to pay higher cost of financing, so they supply less. But at higher prices, suppliers feel that their cost of financing is now reduced. That means at lower interest rates, they supply more. So what you are basically seeing is, in a price quantity diagram, the supply curve is upward sloping. And as discussed, at lower prices, demanders simply see higher interest rate for their investment, so they demand more. Whereas at higher prices, where the interest rates are low, the demanders see that they are receiving a lower interest return for their investment, so they demand less. So the effective demand curve is downward sloping. Where the supply curve and demand curve for bonds interact each other, intercept each other, that's where the equilibrium is determined. And any points above the equilibrium, where the supply is greater, demand is less, what you are basically seeing is a excess supply. So at any point where the demand is greater and the supply is less, you are seeing an excess demand. So this is not different to what you have learned in your general economics, but now we are applying into financial assets, bonds in this case, and the demand and supply curves being established. And we were talking about this market equilibrium in that sense. And we also looked at the demand curve at points where demand curve shows that the demand is greater than supply. As we discussed, it is the excess demand, right? So what happened there is the prices get to push up, and as a result, interest rates reduce to make the market equilibrium. And at points where the bond demand is less than the bond supply, right? That means bond supply is greater, where this point is usually at higher prices. So the prices also adjust to lower to make that demanders are satisfied. So as a result, the prices would, in this case, reduce, the interest rate will rise to make the equilibrium. So through this movement in the market, ultimately we find the market equilibrium where the supply and the demand curve bonds meet each other, intersect each other, and the equilibrium being determined. And the changes, now we will look at these changes in equilibrium interest rates. So basically, we look at shifts. We look at shifts in terms of the demand side, and then also we will come to look at the shifts in supply side to analyze these developments. You see these shifts in the demand side. So what you are basically seeing here is the factors we discussed in the theory of asset demand: the wealth, expected return, risk, liquidity, and then we have brought in expected inflation also into the equation, simply to kind of see the expected return and expected inflation often goes hand in hand in terms of interest rate expectations the market participants build. So we look at these changes in equilibrium interest rate by looking at first shift in the demand side, demand for bonds. So wealth, as you already aware, an increase, if not expansion, in wealth, or in other words, you can call it growing wealth, the demand curve for bonds shift to the right. So that means the demand for each price units that we have looked at would have a higher demand if the wealth is expanding. That means wealth is growing, there would be a higher demand. As a result, the curve would shift to the right. Expected return. Okay, so what happened here is expected return needs to be looked at with some segregation. You expect future interest rates to increase. Okay, so when you see future interest rates to increase, you invest today for longer term bonds, means you are buying them at a higher price, if not lower interest rate. So in future, market is expecting the interest rate to increase. So why you should buy long-term bonds today when you see the opportunity that future you will find these bonds are much more attractive in terms of interest rates. So higher expected interest rates in the future lower the expected return for long-term bonds. Right? So you expect futuristic expectation here, in the sense that you think that the interest rates would increase. So when the future interest rates are expected to increase, that shifts some of the demanders of longer term bonds to not to demand, because you can wait till future to see that interest rates realize to the expected levels and then demand. So today itself, if you buy bonds at prevailing market interest rates, your bonds interest rates would be lower than expected interest rates in the future. So when the interest rate increases, that means prices decline. So you would see your investment is not necessarily yielding desired return in one sense, and also you find that the price that you are paying today is higher than what you would be paying in the future. So as a result, you tend to shift your demand from today to the future. That means today's long-term bond demand reduces, and as a result, the curve, demand curve, shift to the left. In the wealth case, it's shift to the right, but this shift to the left. Then in inflation aspect, so what you are basically seeing is expected inflation, not today's inflation, but future inflation. Okay, an increase in the expected rate of inflation naturally reduce the expected rate of return. Okay, so what you are basically seeing is interest rates you invest today become less attractive if you see future inflation is increasing. Okay, so expected inflation, an increase in the expected rate of inflation lowers the expected return for bond. This also, like expected return, push the demand curve to the left, because you find investing today for longer bonds is generally not attractive, given the fact that in the future inflation is expected to rise. So what happened there is, if the inflation rises, naturally the expected return from bonds reduces. So what you find here is the demanders demand less, and as a result the curve shift to the left. And risk is, as always, you find that higher the risk, right, you have already aware the fact that risk can return. Higher the risk, higher the return. Lower the risk, lower the return. That we understood, right? But increase in risk, okay, what happened there is some people are risk averse. They were wanted to take risk, so they kind of move out from demanding bonds when the bonds risk increases. So an increase in the riskiness of bond push the demand curve to the left. As a result, lower bonds would be demanded. Similarly, you see the liquidity. We already looked at higher the liquidity, more demand. And effectively, more demand means generally higher prices, right? So when you see market participants see a bond which is very liquid, most of them would like to hold that bond, simply because they can get more opportunities to sell that bond many times than a bond which is not necessarily liquid. So what you are basically seeing is higher liquidity, right, results in the demand curve shifting to the right, more demand for that particular bond. So from factors that shift the bond demand curve, you find wealth and liquidity actually increases the demand when the wealth increases or liquidity is high. So both are positively related in that sense. Increasing wealth, increasing liquidity, increase the demand for bonds. So as a result, the bond curve shift to the right. Similar analysis if you apply to the expected return, expected inflation, and riskiness. If the expected inflation, expected return, and risk increases, that would reduce the demand for bonds, and the demand for bonds curve shift to the left. So you can see these elements in terms of your own exercise of drawing a similar demand curves and apply the considerations that we have highlighted. So when you see an increase in demand for bonds, you see the curve shifts to the right, and as a result, you find for each price that you were noticing prior to this shift in the demand curve, the quantity demanded with higher demand now established is greater. So you find, for instance, B in the blue curve here, you find it increases to B prime in the red curve. Similarly, D is moved to the D prime in the rightward shifted higher demand bond curve. So you basically see bond demand curve is shifting for each price units, price points that we were looking at in this case when there's a shift. Similarly, if you put all these elements that shift the demand and the direction, change in variable, change in quantity demanded, and you also can draw them and show it is in a picture form in this slide here. So wealth change in variable is increasing. So what you are basically seeing is that shift the demand curve to also to increase. So as a result, shift to the rightwards, you see BD1 becomes BD2. So at each price point, higher demand is now established. And similarly, expected interest rate, okay, when the expected interest rate increases, the change in quantity demanded at each bond price reduces. We discuss. As a result of this, the long-term bond demand curve shift to the left. New bond demand curve is lower in terms of volumes for each price units that you have observed. Expected inflation, the direction is increasing. As a result, change in quantity demanded is lower. So again, like expected interest rate, you see that each price unit, now they demand less volumes of bonds. So the BD2 curve is shifted to the left. And similarly, riskiness. Increase in risk reduces the quantity demanded. As a result, bond curve shift to the left. And then liquidity, like wealth, increasing liquidity would increase the quantity demanded. And for each price point, price unit, you find the more bonds being demanded. So the bond demand curve, BD2, is shifted to the right in that instance, right? So you see all these behavior in terms of demand side. So any questions that you have with respect to the shift in the demand curve for bonds, you can keep noted, and you can raise it when we meet next time for the discussion. So this, as I said, is a recording for your information, and we will now move on to look at how the shifts in the supply side of the bond curve behave. So supply, expected profitability of investment opportunities. So you find investment is more profitable. You immediately think of expanding your business, expanding your project, expanding your investment possibilities. So that itself says that the direction is to supply more in terms of raising required funds, required capital. So for each price unit, now you are ready to supply more bonds. So the supply curve shifts to the right. Right? So expected profitability of an investment opportunity makes that the expansion decision more attractive. So you tend to supply more bonds, and as a result, supply curve shifts to the right. Expected inflation, right? That also similarly behave, because when the expected inflation is high, an increase in the expected inflation, you find even if you supply certain amount, the market would respond, and the amounts that you collect in terms of required finances because of higher inflation and higher interest rate. As a result of that, the volumes that you can raise is lower compared to a lower expected inflation scenario. So now you require, if you have a X volume of funds required to be raised, when an environment where expected inflation increasing, you find that you have to supply more bonds to raise same amount of funds. This is similar to at a X amount of funds requirement at, let's say, 6% interest rate, you require to supply certain amount of bonds. But when you find the interest rate from 6 is increasing to 10% because of increasing expected inflation, naturally, to raise the same volume of funds, you tend to supply more bonds, right? So as a result, you find when the expected inflation is in an increasing trajectory, you have to supply more bonds, and the bond supply curve shift to the right. Then government budget, higher budget deficits, more funds to be raised. So more bonds naturally supplied by the government. So this is no different to expected changes in terms of a direction that we have now analyzed in terms of profitability, inflation, then of course the budgetary direction. Higher budget deficits requires higher financing. Higher financing means more bonds being supplied to the market, and the supply curves shift to the right. So you can see here the direction in terms of change of variable, what happens to the quantity demanded, and what happens to the supply curve. In all the cases that we looked at, profitability, expected inflation, the government deficits, if all changes, all variables are changing in favor of increasing trajectory, what you are basically seeing is more quantity being demanded, more quantity being supplied, not demanded. So as a result, supply curve, which is upward sloping, as you already aware, shift to the right. So you find a new higher supply curve at BS2, the red line, red curves compared to blue curves in BS1. So higher bond supply as the result of profitability, expected inflation, and the deficits. So you basically see here application of these shifts. For instance, if you look at H point, because of supply curve now shift to the right, it moves to H prime. So G point, you find because of supply curve is now shift to the right, you see G prime. So connecting H prime and G prime, you see a supply curve, new supply curve, which is not the same as the previous blue curve, and the new curve is shifted to the right because you require to supply more bonds because of these changes that we discussed. And ultimately, the changes that we discussed drive the market equilibrium. Okay, so as a result of the changes, right, both the demanders in the bond demand curve and the suppliers in the bond supply curve, okay, so you find here a rise in expected inflation. What happens to the demand? Demand reduces. When you see the demanders reduces the demand for bonds because expected inflation is greater, the new bond curve BD2 is shifted to the left in the price and quantity frame that we are discussing here. So you find the new demand curve is more towards the zero side of the chart that you are looking at in this slide. So the lower demand that you are reflected, and you find similarly what happens to the a bond supply when you see expected inflation is increasing. So higher expected inflation increase the suppliers because they wanted to raise same volume of funds, let's assume, but require now more supply because interest rates, because of the increasing expected inflation, would have adjusted upward. So as a result, the bond supply curve now shift to the right, BS2. Bond demand curve shifted to the left, bond supply curve shifted to the right. So what you are basically seeing is equilibrium point of intersection of both demand curve and supply curve. You look at the point of intersection of red curves here, that is point 2 in the equilibrium consideration from equilibrium point 1 of blue intersection of supply and demand. So you are ending up a lower price. That means higher interest rate. Okay, so equilibrium interest rates, because of this reason, because of supply curve shifting to the right, demand curve shifting to the left, because of higher expected inflation, results in equilibrium to settle at a lower price point. In other words, higher interest rate point in terms of supply and demand in the bond market. So this is quite interesting in terms of the interest rate behavior and of course expected inflation behavior. So you find here, when the expected inflation is increasing, here the expected inflation is increasing. What happens to the interest rate? So interest rate also increases, right? So then you find similarly, when the expected inflation decreases, that is the red line here, red is expected inflation, you find interest rates also decreases. So if you analyze the longer term expected inflation and interest rates behavior, because you are investing to the future, so you are basically looking at future inflation, right? So when future inflation increases, you expect interest rates to compensate. So you expect a higher interest rate in such circumstances. So very clear in terms of how expected inflation and interest rate behave. So more or less, with the higher expected inflation, interest rate also tend to increase. And by looking at this expected inflation and interest rate, you can again conclude about real interest rate picture, right? Whether real interest rate is positive or negative, you can conclude that by looking at this chart itself. But I'm not going to touch upon this real interest rate business at this juncture of this discussion, because you will learn about that as we move on. But what is interesting here is, when the expected inflation tend to increase, interest rates behave in the same direction. When the expected inflation tend to decrease, interest rate also behave in that direction. And more or less, it follows. Interest rates follows the direction set by the expected inflation. So expected inflation leads interest rate behavior. But at times, interest rate could also, but generally by looking at this here, it's very clear, right? So the interest rate started declining after a little lag. I mean, after some time where the expected inflation started declining, right? So it's very clear from a perspective here. Expected inflation started increasing. Interest rate also started increasing after a small lag time. So you see this relationship in terms of expected inflation and interest rates. That's very much established, except for the fact that during periods of financial stress, financial difficulties, if not financial crisis. In recent episode of 2008-9 financial crisis, see the expected inflation hitting into negative territory. That means not inflation, it is deflation, negative inflation. And then the interest rates are almost at zero flow, right? So reasons for this type of a behavior, we also would be able to elaborate, discuss once we start discussing financial crisis in our future lectures. So you might see the interesting application of what we are learning already in terms of these developments. So we'll come back to some of these points and describe, try to understand in our coming discussions. But if you have any questions in your mind by looking at and analyzing our previous slides that we discussed, you can take note of those clarifications that you are interested in. So we will try to follow up them in our next discussion. So you see the kind of a market equilibrium. In terms of business cycle expansions. What is business cycle expansion? Effectively, a business cycle is nothing but that you are reviewing your long-term growth trajectory. The countries have growth paths. So you find the business cycle is continuously going up for a certain duration, and then started again coming through a period of a declining growth trajectory. So you see a peak, you see a bottom, in between you see a increasing trajectory, decreasing trajectory. This is the behavior of business cycles, right? So the period of business cycle expansion means you find the economy is continuously growing. So what effectively that indicates is you find the economy is growing, all the businesses looks profitable, right? You need to now finance and expand. So you effectively have a new supply positions, that is a higher supply of financing requirements by economic agents. So new supply curves would definitely reflect a higher bond supply in terms of a business cycle expansion. You see here the BS2 red curve shifted to the right in such circumstances. So the demanders, from another perspective, when the business cycle expand means their income also increases. So profitability of businesses ultimately goes to the hands of the business owners, so shareholders, the government, and everybody. So they become rich because of the continuous expansion in the economy. So they become wealthy now. That means their wealth increases, their income increases directly with the expansion in businesses and profitability and things like that. So the demanders also demand more. So the demand curve also shift to the right, but most of the time not to the extent of supply curve shift, because suppliers now require more funds. Demanders get some profit being kind of factored, and they become also benefited from expanding economic activities. Most of the people become rich and also have more resources. They also demand, but at the same time, people also tend to kind of, you know, demand certain amount, but they also keep certain positions in terms of savings and things like that. That also subsequently come into the picture in terms of availability of assets for the economy to expand. But what you are saying is both supply curve and the demand curve shift to the right in an environment of expansion, business cycle expansion. Okay, and as a result, what you are seeing is the price, more demand, more supply, but supply is outweighed the increase in demand. As a result, the equilibrium now comes to a point where the new price is lower. That means to say price falls, that means a higher interest rate, but the quantity, okay, would definitely be higher than previously in terms of business cycle expansion. So you can see the equilibrium point 1 has moved to the equilibrium point 2 here, and the price is from P1 to P2, lower price, that means higher interest rates. The volume also reflect a higher volume compared to the previous equilibrium. Right. So you see here in the case of US, 3-month treasury bill interest rate behavior. One of the most liquid, most sought after financial assets in the world, the treasury bills. Within the treasury bills, the shortest maturity is usually 3 months. And how the interest rates of US 3-month treasury bills behave over a longer duration. And the shaded areas that you are seeing in this chart is, sorry, in this chart is period of recession in US economy, right? So period of recessions are reflective by these shaded areas. So here what happened is business cycle, no expansion here, okay? In fact, business cycle contraction in the case of US. And there you see when the economy is on expansion pace, economy is on an expansion pace, economy is on expansion pace. Even here, economy is on a growth trajectory. Business cycles are expanding. What happened to the interest rate? Interest rates are increasing, not necessarily to a level that you experience in the past, that due to various reasons. For instance, even in US in mid or early 80s, even the 3-month treasury bill is high double-digit numbers, 16%. Right? Now what you are seeing in US for 3-month treasury bill is less than 10 basis points. Sometimes it's about 15 basis points. Not even a 0.25% interest return. So effectively you are seeing here at points where economies are expanding, business cycles are expanding, interest rates tend to increase. That means very clear in terms of our previous slide, the prices decline. Lower prices means higher interest rates. So that is again reflective, but then you cannot compare one period against the next to see that the prices are now lower than previous points. No, because interest rate structure completely changes with other variables also brought into the equation. So effectively, the relationship in terms of what happens when the business cycle expands is clear with this empirical evidence that you are seeing in terms of US market behavior for interest rates of 3 months treasury bills. Right. So you looked at bond market all throughout. Okay. So now we are looking at supply and demand in the market for money. Effectively, money market supply and money market demand. So we look at this money market supply and demand from the perspective of a framework or a concept called the liquidity preference framework. Okay, so this is a Keynesian model, okay, that determines the equilibrium interest rate in terms of the supply of and demand for money. That's the money market. So we are trying to now move into the money market equilibrium considerations. So let's assume there are two main categories of assets that people use to store their wealth. Okay, so you can expand this, no problem, but easy when you see you simplify your assets to store your wealth. You have wealth, you want to store this wealth, so you have two main categories of assets. One is money, other one is bonds. Okay, so if you consider this as the two assets, so you can also conclude the fact that the total wealth in the economy should be, supply side of these bonds should be these assets, right? Not only the bonds, here we look at money also, should be equal to the demand side of these assets. So what we are trying to write down here is an equation to say that bond supply and money supply should be equals to bond demand and money demand, because you now factored and concluded the fact that the wealth is stored in two assets. One is money, one is bonds. If you want to expand this, but then you also write to say supply side equals the demand side. You can rearrange this. Bond supply and money supply equals bond demand and money demand by adjusting the supply and demand of one type of assets to one side of the equation. So you take bond supply and bond demand to one side, and you then ended up with writing down money supply and money demand in the other side. So what you are basically seeing is when you take bond demand from the other side of the equation, where it is positive, when you take it to the left side of the equation, it becomes negative. So bond supply minus bond demand equals money supply minus money demand. So you are taking money supply to the other side of the equation, or you are taking, right, the money demand to the other side of the equation. So either way, what you are seeing here is you find bond demand and a bond supply being placed, rearranged into one side, and money supply and money demand is rearranged to the other side of the equation. So to conclude, if the market for money is in equilibrium, right, so it is nothing but money supply has to be equal to money demand. Okay, so at any equilibrium point, supply should equals to demand. Okay, so you already know the bond market is also in equilibrium. If not, the bond market equilibrium means bond supply equals bond demand. So that's what we were doing in all past few slides that we were analyzing, discussing. So to say that demand and supply of bonds were equal at point equilibrium. So similarly, money market also has to be in equilibrium at points where money supply and money demand are equal, right? So this being said, you find here an interesting description in terms of equilibrium in the market for money, where money demand curve behaves in a certain pattern, whereas money supply curve behaves in a certain pattern. It is easy for us to take money supply curve first here, because quantity of money supplied in any economy is a function of what the monetary authority or the central bank consider appropriate in terms of monetary volume that should be available in the economy. So money supply as a result is vertical, irrespective of what is the interest rate structure in the economy. So please remember, the money market curve being drawn, the y-axis being considered not in terms of price, but in terms of interest rate. So if you say interest rate, higher the interest rate, what is the price? Lower the price. Lower the interest rate, what is the price? Higher the price. So if you are trying to draw this same in price term, the price should be lower at interest rate 0.30 than price at interest rate 10%. So here the prices are coming towards the x-axis, prices have to increase. But effectively, when you draw the other graph, you have seen the prices are increasing this direction. So remember those directions. But what matters is you are drawing the money market equilibrium point in terms of interest rate and the quantity of money. Bonds that you have drawn in terms of the price. Still, you can draw that for the interest rates if required, but we don't need to complicate ourselves. So we just go by the standard practice. So you are basically seeing in the money market, the supply of money is a determinant of the central bank. So they decide what the quantity of money that should be available in the economy. In this case, it is $300 billion as per this chart. So money supply curve is vertical because it's a determinant of what the monetary authority or the central bank in terms of the supply. So the demand curve. At high interest rates, these are very straightforward. These are very interest rate. At high interest rates, this is a very straightforward kind of analysis for you. When the interest rates are high, demand for money is low. Why? Because when you keep your wealth in money form, you forego the possibility that the wealth could make or earn some interest for you. So you keep only the required, if not very much required portion of the money in money form of your wealth. The balance you tend to keep it in either bond or any other assets, but we, for simplicity, took the consideration the wealth being stored in either money or in bond. You have other assets also, but effectively, more money you keep in money form, that money would not earn you anything, but effectively lose you the value if there's inflation. So you tend to hold less money, and this becomes very significant at high interest rates because amount that you can regain or you can gain as return by investing that money at high interest rate is greater. So if not, right, if you do not invest at high interest rates, what happened there is the amount that you can gain by holding them into a money form, you don't get anything. So you tend to only keep required amounts. As the interest rate reduces, the opportunity cost of holding money also reduces. At high interest rate, you know the opportunity cost concept in economics, right? Best foregone alternative. So what you are basically seeing is when the interest rate reduces, you can keep more money because you are losing little now. The interest rate are increasing, you lose more. So as the interest rate declines, you tend to keep more in money. compared to high interest rates point where you tend to keep very little. So similarly, demanders demand less volumes when the interest rates are high. When the interest rates are low, the demanders demand less quantities. When the interest rate decreases, you find the demanders of money now become indifferent. They can hold more because the opportunity cost of holding money in your wallet is now lower. What you will lose is, let's say, 5% compared to 25% at point A of this chart. So effectively, money demand curve is downward sloping, mean to say at high interest rates, lower money is demanded compared to lower interest rate where high monetary volumes being demanded. So it's a downward sloping curve, right? So the point where money supply is vertical, demand curve is downward sloping, where this intersect here at point C, you find the money market equilibrium is established, right? So points where you see interest rates are lower than the equilibrium level, demanders have more demand. That means the excess demand prevail. And as a result, right, what happened here is the interest rates tend to push up towards the equilibrium, right? Similarly, at points where money supply is greater than the money demand, this is points where the interest rates are greater than equilibrium interest rate, excess supply prevails. So interest rates tend to push downwards to achieve the equilibrium. So it is very straightforward from the perspective that the vertical supply curve of money, where the monetary authority decide what quantum, what quantity of money should be there in the economy, and then the downward sloping demand curve, which intersect each other, that determines the equilibrium in the market for money. Hope this is very clear, and if not, please take down if you want to clarify anything. So we will revisit some of these as we meet in our next class. Right. So what's the liquidity preference framework tells about demand for money? As the interest rate increases, as I explained to you already, the opportunity cost of holding money increases. What is in your wallet do not work for you. So you lose more opportunities to earn a good return. Okay, so at high interest rate, opportunity cost of holding money is greater. Okay, so similarly, right, high interest rate, as a result, the quantity demand of money is lower. It also decreases because you find you are losing more. Relative expected return of money also decreases. Holding money becomes less attractive. That's what relative expected return, right? So you hold money, you are not gaining. So you tend to hold less quantity at high interest rates points. Right. So what happens to the equilibrium interest rate in the liquidity preference framework when changes happen? So the demand side shifts in the demand for money. There's two types of effects. One is income effect, other one is price level effect. It's very straightforward. A higher level of income. So countries are growing, people are earning more, it's quite natural that you demand more money. So at points that we looked at in terms of interest rate, at each interest rate point, now you want more money than what you used to as the income increases. So higher level of income means you demand more, and the demand curve as a result shift to the right. Income effect. So you previously, when you were not having an employment, you had some amount of money. Probably your parents would have given for your pocket expenses. Now you are working, you are earning. So as a result, you have a higher income. You have at least an income now compared to previous status where you haven't had an employment. So even while you are in employment, at different stages, your income also increases. So you find higher level of income, so you demand more money. You probably know in your wallets, you probably carrying more money now than previously. So you find higher demand. Similarly, in the economy is also same. Your demand for various things also increases. You used to have a lunch from the university canteen, right, for a reasonable cost before you get an employment and work. Now probably now you go to a restaurant and eat, so you need to have more money, so you demand more money in such circumstances. That shift the demand curve to the right. The price level effect. So price level effect. Price level effect is inflation. Okay, so rise in price level is inflation. So what happens if the inflation is high, increasing? The amount of money you had is now not sufficient to get the same amount of work done. Let's say you wanted to bake a cake. The amount of goods and requirements that you, in terms of money, you require to spend to buy the required goods to bake a cake. Now, with the inflation, needs to be upsized. So the same amount of money that you use is not sufficient because prices have gone up. So you need to have some additional money. So as a result, what happened here is price level effect also drive your demand for money to increase. As a result, demand curve to shift to the right. So both income effect, price level effect shift the demand curve to the right in terms of liquidity preference framework. Supply side. So you already know it's controlled by the central bank. They are the ones control the money supply. So in this sense, an increase by the Fed Reserve, that's the US central bank, or for that matter, any central bank in a jurisdiction, would shift the supply curve to the right. If they wanted to reduce the money supply, the supply curve would shift to the left. So the vertical line that you were looking at would move left or right based on the decision of the monetary authority. Okay, so you see the shift in the money market supply curve and the demand curve in terms of liquidity preference framework for demand side. Supply side is often determined by the monetary authority or the central bank. So you can now factor the income and price level effects that we talked about, the money demand in terms of the change of variable. So what you are seeing here is increasing income, increasing price level, shift the demand curve to a higher point. So the demand shift to the right, and you can see here the red new demand curve is now intersecting the vertical supply curve at a higher point. That means to say interest rates are increased in this scenario. And similarly, the price level, you need more money to do the same amount of work. So the demand curve is now new demand curve, right? It established at higher points. So you basically see the intersection that drives the interest rate to increase, the equilibrium interest rate to increase. When the supply curve is looked at, money supply, if the money supply being increased, this is controlled by the monetary authority, you find what happens for a given demand curve, higher money supply would push the intersection point to a lower in terms of interest rates. So interest rates declines in such circumstances. Expanding money supply would push the interest rates to decline. Expanding money demand push the money demand curves to shift to the right, and as a result, for a given money supply curve, the interest rates rise in these two circumstances. So you can see here income or the price level change, money demand curve shift to the right, and the intersection happens at a higher point. As a result, equilibrium interest rate increase. So this is the same thing explained in the a previous slide in terms of further details. So effectively what you are seeing is the money market, often the demand behavior would define where the interest rates lands for a given money supply quantity. So the money supply quantity also could vary based on the monetary authority's decision. But often the behavior in the movements of interest rates happens with demanders, demand curve adjustments. So that's reasonably clear, I believe, from this explanation. And you have, if you have any clarifications required, please note them down, so we'll be able to revisit some of these in our next discussion. Then you see supply curve, shift in supply curve. Right. So we were looking at the supply side of the money market. So as you're already aware, the fact that money supply is often controlled by the monetary authority or the central bank. So shifting money supply curve to the right, that means increasing money supply, would drive the interest rate, equilibrium interest rates to a fall. And you can see the intersection of demand curve and the supply curve would decide the interest rate in this instance. Right. So then you analyze to some extent price level effect and expected inflation effect. Interestingly, a one-time increase in the money supply, right? So it's a jump in money supply from X to, let's say, X1, right? So X1 is higher in quantum of money available in the economy. So this would tend to kind of cause prices in the economy to rise to a permanently a higher level by the end of a particular period. Let's say end of the year line. So it is a one-time jump. Okay, so you see price level also increased, right? So when you see that price level increase, the price level effect will push the demand curve, as you are already aware, right? So because of interest rate, as a result of this price level effect, right? So interest rate would rise. So this is like you are now seeing that the higher prices have driven the demand curve to move out. So that means to expand. As a result, you have already seen in the graphs that the new equilibrium occurs at a higher interest rate. But interestingly, price level effect remains even after prices have stopped rising, because whether it's a one-time increase has caused the prices to rise in supply of money, still market would not necessarily know it's a one-time or not. So there's a possibility price level effect to remain even after prices have stopped rising. That means people tend to demand more in such circumstances in terms of money supply, money demand, sorry, right? So because of the price level effect, they tend to demand more than what they used to, because of recent experience that they have seen the prices increased, and as a result they have demanded more. But now prices have stopped, but because of that tendency, expectation, there may be the possibility that price level effect still remaining. So the rising price level will raise interest rate because people will expect inflation to be higher over the course of the period that we are looking at, right? So once this prices stopped, that means prices increasing stops, where the expectation of inflation, once it returns to zero, right? So the expected inflation only persists, if not only influence the demand side to push the money demand curve out, as long as prices continue to rise. But if it stops rising and inflation returns to zero, expected inflation effects also wanes out. But the possibility that you see price level effect, even after seeing that the prices increasing stopped, could remain in the market, and people would demand more in terms of price level effect because of the expectation, right? But expected inflation effect only persists as long as the price levels continue to rise. So these are empirical driven analysis. You will generally see the behavior of these in terms of how this influence the general direction of money supply, money demand behavior that you have analyzed in the charts. But some similar question one could pose, one could ask from you. For instance, a higher rate of growth of money supply, does that lower interest rates? Okay, higher rate of growth of the money supply. Generally, you see the money is growing. Every year, money supply is increasing. Because you find in an inflationary environment, right, and the economies are growing economic environment, now you need more money than what it was in the previous year. So you see under normal circumstances what the growth levels of money, but a higher, let's say if it is 5% growth, all of a sudden if you see 10% growth of money, would that lower the interest rates? Right? So you look at liquidity preference framework, okay, that leads to the conclusion that an increase in money supply, that means the vertical curve shift to the right, when the demand curve remains the same, would lower the interest rates. So it is very straightforward. The liquidity effect emphasizes that the increasing money supply has contributed to lower the interest rates, and the influence has been driven by the liquidity itself. This is under the liquidity preference framework explanation. Then we look at the income effect aspects that finds that interest rates increasing because increase in the money supply is an expansionary influence on the economy. That means people's income has gone up. That's the income effect. Okay. And as a result, because the money supply has contributed to have higher income among the people. So this drives to expand the demand side of the equation. Okay. So income effect refers to demand side. Liquidity preference frameworks, money supply expansion in terms of new money supply effect, the liquidity effect. So that argued that the interest rates to decline, but the income effect argues the fact that demand curve shift to the right. As a result, right, interest rates to increase. So these are again you are applying in terms of the direction to which the demand curve or the supply curve moves. Okay, but remember, when you are explaining through liquidity preference framework, that you have to highlight the fact that the liquidity effect to the money supply side, and as a result, interest rates decreasing. Whereas income effect, this is the demand side. So the expansion influence on the money demand curve would push the interest rate to increase. That is the demand curve shift to the right. So that's how you have to look at these applications. Right. So the same thing from a price level effect. Okay. So when the price level effect play a role, and price level effect would highlight the fact that increase in the money supply leads to a rise in interest rates, right, as a result of rise in price level. So it is again the demand curve where the increase in money supply would result in prices to rise. Prices to rise means, right, price level effect that is driving the demand curve to shift to the right. As a result of demand curve shift to the right, the interest rates will increase. So that's the price level effect that you are explaining. Previously, you had the income effect. Now you are seeing price effect, and you have seen liquidity effect. But price effect and the income effect that has contributed to shift the demand curve out, and as a result, interest rates to increase. Whereas liquidity effect that contributed to shift the supply curve out, as a result, interest rates to decrease. And expected inflation effect, if you apply the expected inflation effect, what it shows is an increase in interest rate because an increase in the money supply may lead people to expect a higher price level, right? Even prices stops rising, still people expect a continuity because they would say, oh, prices would continue to rise. So they expect future inflations to be greater, although now inflation stops rising, right? So they expect more demand of money. As a result, the demand curve shifts to the right and the interest rates would increase. So effectively, all influences on demand curve to shift to the right would drive interest rates to increase, where all influences that drives the supply curves to move to the right would reduce the interest rate. So that's the basic idea in terms of the money market equilibrium that I wanted to highlight. And you can derive these points by drawing the curve by yourself. So you will understand, you will learn the concepts in terms of the behavior by looking at these on that basis. So this figure, right, highlight what effect is predominant in circumstances. So if you find the interest rate, okay, as a result of growth in money supply, first reduces simply because liquid effect, and subsequently because of income, price level, and expected inflation effects tend to move up a bit, but still the new equilibrium and landing points are lower than the previously prevailed interest rate. You find the liquid effect is larger than other effects in such circumstances. So you find here liquid effect push down the interest rate significantly. Then the other effect, income, price level, and expected inflation, push up the interest rates to some extent, but not to the level prevailed prior to this liquid effect setting. So the new interest rate level sets somewhere below the originally prevailed interest rates level. So what it entails for us to understand is liquid effect is stronger than other effects in these circumstances. Similarly, when the money supply increases, there's a money supply growth, immediately liquid effect would set the interest rates to decrease. But subsequently, if you see the price level, income effect, and expected inflation effects could drive the interest rates to increase beyond the level prevailed prior to the money supply increase. So here you will end up having a situation where the interest rates settle at a point higher than what it was previously. So effectively here the liquidity effect is smaller than the income, price, and expected inflation effects. Then also you would find a circumstance where although the money supply has increased, right, still interest rates started increasing straight away. Where you see here, even the liquid effect, money supply has increased, interest rates are increasing. And then what you are seeing here is the expected inflation, price level, income effects are driving the interest rates to rise, where liquid effect is smaller than all the other effects that we were discussing. This may be why this has no influence at the first step to see that interest rates decreasing like in previous two, what we have discussed. Maybe this increase in money supply in the eyes of market is not sufficient. Market might have expected money supply to increase by 10%, but money supply has increased only by 5%. So market already kind of a build expectation interest rates to increase because money supply increase is not sufficient to maintain the levels of interest rates. So these possibilities exist. These possibilities arise in markets. And you may find liquidity effects either supersede or becomes subservient to other effects, and as a result the interest rates would settle at points either lower, higher, or much higher based on the influence of each effects in the money market. You can see here the US experience of money growth and interest rates against 3-month treasury bill interest rates, that is red line. The interest rates are given in right hand axis, left hand axis, sorry. Okay, so the money growth rates are here in blue, that is in left hand axis. So you see here the behavior of interest rates, behavior of money growth. So what it says is growth over the stock during this period, the money stock in US have increased by 16%. Here again in 2000s, the money stock has grown by, let's say, somewhere around 15 to 16%. So all these periods, what you are seeing is money stock is growing at very smaller pace or at reasonable pace, but interest rates are decreasing. What it says here is the liquidity effect is stronger. That's why interest rates are decreasing. But here, still money supply is increasing. These are growth. These are all positive numbers, not negative numbers. It's growing. Here you see, because of that, the interest rate started declining. Let's say 75 early periods, you see interest rates are declining. So liquidity effect is stronger here. But subsequently, this is still money supply is growing, but at a lower pace. At a lower speed, the money supply is growing. So here the interest rates are started picking up, increasing. Money supply is also increasing, but at a lower pace. Interest rates started increasing simply because here what you are seeing is market expect a higher money supply growth rate, but effectively the growth is lower. So the liquidity effect is not necessarily strong. That means liquidity effect is smaller than other effects. So the increase in interest rate is visible, right? So here, still points where interest rates continue to increase. Here you can see, despite money supply growth prevails, but at a lower pace. So here it would have been other effects that's driving the market interest rates to offset any money supply driven influence to the interest rate. So this is a very important yardstick in terms of how financial markets look at the possible interest rates behavior in line with the money market money supply developments. But what is interesting here is the interest rates that you have analyzed here is short-term interest rates, treasury bill 3-month, whereas other market interest rates that could be for longer tenor treasury bond interest rates that would behave differently. So we are not taking that into the equation here. That would be behaving differently than the short-term interest rates. So these are empirical application of some of the equilibrium points in the money market that we studied here. And previously we studied in terms of the bond market equilibrium, very interestingly looking at inflation and interest rate in that exercise. So these are very important. You will be able to kind of analyze and apply your knowledge into the consideration. So if you wanted to clarify anything on these aspects, you can note down. So this is ideal point for me to stop our discussion for today's. This recording will give you the details of all this, what we discussed. And we will move into a new discussion topic that also in terms of interest rates. But interestingly, that discusses about risk and term structure of interest rates. So we will start from term and risk structures of interest rates in our next lecture. So with that note, I'll stop at this point, and we'll be able to meet in our next class as usual on Saturday mornings. Thank you.